How do you pick the right property and avoid choosing the wrong one? By the end of this video, you're gonna know the 10 property types and which are worth your time and money and which are not. Let's get into it. And to make it fun, we're going to play a game called Who Wants to Be Financially Free? There's levels to the real estate investing game, similar to Who Wants to Be a Millionaire. And when you start the game, the questions are going to be a lot easier. The stakes are lower and so is the risk. But as you climb higher up those money tiers, like in the game, the questions will get a lot harder. But if you can answer them correctly, the rewards, the prize money, can be life-changing. But one wrong move can be game over. And just like in the show, you have lifelines to reduce your risk. So if you remember in the show, you could phone a friend. This is like your mentor or trusted advisor in real estate who can guide you. However, sometimes you make that call and your friend doesn't know the answer either. How you win the game is really understanding your resources, your network and connections, so you know when to level up, when to walk away and hold off. Because sometimes it's not worth taking that risk. In real estate, there's two main categories of property types. You have low risk residential and high risk commercial. Residential is really just used for living. People that are longer term tenants or shorter term tenants, but it's used for living. So it's really quite simple to understand. So within residential, you have single units and multi-units. So single units would be like a condo, townhouse, single family home, mobile home. These are like your $100 questions in the game of Who Wants to Be a Millionaire. Everyone can usually answer these questions and figure it out, and that's where the game starts. And according to Redfin, 74% of investor purchases are single family homes. So a lot of people do begin there and they figure it out. The challenge is, of course, it's really hard to squeeze enough cash flow from a single unit property to be financially free. So you can't really walk away yet. You got to keep playing and learning how to level up. And that's when you're going to level up into the residential multifamily category. So this is actually where I began, and you can get a lot more cash flow if you do it well. So you have duplexes, 2 units, triplexes, 3 units, and quadplexes, which are 4 units. This is where it gets really interesting because you have multiple tenants cutting you checks in one property. So if something happens, let's say to one tenant and they don't pay your rent, then you have the others to help you cover the expenses like your mortgage, your tax, insurance, utilities. And another huge advantage that I think a lot of people underestimate is that as you go up in the unit sizes, like a 4plex, for example, you're buying in bulk. So the price per unit is cheaper. Kind of like at Costco, the price per item is cheaper if you buy more items together. The downside is that the upfront investment is going to be more in residential multifamily than the single units. And you're going to have more tenants, so more management, more maintenance. But if you're serious about playing the game, this is where you'll start building more momentum. And before leveling up into the multifamily residential category, you should be able to answer questions like this. What are 3 factors to consider before renting and selecting a tenant? An answer could be rent to income ratio, your landlord reference, and a work reference. So attached to each property type, I'm going to be asking a question to see, engage your kind of knowledge on that property type. To also help you to figure out if you're supposed to be at that level yet. Another property type that I think a lot of people forget about is land. And this could be either residential or commercial. It really just depends on the zoning of the land. So let's say you're not going to develop the land, because if you are, it's going to be a lot harder to answer the question. Trust me on that. I've been doing some land development. It's not easy to navigate. A big pro though of buying land is, especially it's just dirt, right? So there's really no operation. A con is that it's usually going to be more cash intensive. You're going to have to buy it either totally in cash or like 50% of it in cash. Financing is usually not involved because there's no operation of the business. You're not really buying a business necessarily. A question might be, how do you though gain cash flow from land? And an answer could be, well, you can rent that land to someone for camping or for storage units. So now we're going to be climbing higher up into the life-changing questions. These are going to be your commercial properties. So if you can answer these correctly, there's a good chance you'll be financially free. But incorrectly, and your wife won't be happy, you might not be coming home with any prize money. So it took me a while to really figure out the commercial property types. There's quite a few of them. I'm going to break it down in the simplest way possible. The first one is going to be your commercial multifamily. This is 5 units or more. The pro is that they'll be more recession proof because you have even more tenants helping to cover your expenses. Say in like a 20 unit building, you have 20 tenants. And also they're usually longer term tenants, which is even more sustainable. A con might be like, I luckily haven't had this happen to me, but I've heard of tenants ganging up against the owner. So you want to be able to keep the tenants happy and on your good side at scale. So your tenant relations will be tested. A question might be like, how do you prevent retaliation from the existing tenants that are maybe saying paying $2,000 a month if you need to lower the rents in your apartment building to $1,500 a month? And an answer might be having them actually, like as the new tenants, sign an NDA, a non-disclosure agreement, to make sure that they can't share what they're paying for rent and avoid more of like a mutiny. So most investors start at residential or commercial multifamily. I think that that's the best starting point for many people. The questions actually get really hard from here on out, so you've got to be careful. And so the next property type is mixed use properties. You think of work, live, play. These could be like boutique shops, offices, living spaces, and a whole bunch more. So a big pro is because you have a variety of different types of tenants and ways to make money in the building, it's more sustainable or more diversified, so it helps in market changes. A con could be like, well, because you have so many different types of tenants, you have to know how to manage each different type, right? A good question in this type of property is, how do you get the insurance policy to work if there's multiple streams of income coming in? And the answer is that it's a lot more expensive to get mixed use property insurance, right? So you have to know how to navigate that and how to make sure that you're getting the right policy. Actually, one of my favorite property types is the next one. So that's healthcare properties. Assisted living, nursing homes, and rehab centers would be examples. Pro is there's a growing demand for this type of property. With the aging population, like the baby boomers are needing more and more places like this. The con is that there's higher operating expenses and regulatory risks. A good question might be like, what are the key factors when choosing where to invest in a nursing home? An answer might be like, well, looking at population age trends, proximity to major healthcare facilities like a hospital. Those are like things to consider when you're buying in a certain location. And moving on to the next property type, hospitality, hotels, motels, and inns. Pro is, well, you have shorter stays and you have multiple income streams a lot of the time. So you can bring in even more cash flow. Owning a hotel is also, I think, pretty cool. A con might be, well, when the economy changes into like a recessionary period, the market downturns, vacations are usually one of the first things that people cut as an expense. So it's harder to get financing due to the increased risk. Question would be like, say, if you're going to get into this type, you have to know, what is RevPAR? What does RevPAR mean? It's revenue per available room, and it combines the occupancy rate with the average daily rate. The next property type is office buildings. Pro, tenants are business professionals. So now you're doing more B2B transactions, of course. Multiple year leases are in place. Sometimes the businesses that come in even make like improvements to the property for free. Con though is like, with the rise of remote working, there's a lot of uncertainty with this property type. So a question for this category would be like, what are triple net leases? An answer is, well, it's the tenant being responsible not just for the rent and utilities, which they usually are. It's also tax, insurance, and maintenance. So they're really covering basically all of the expenses. All right, and the ninth property type is industrial property. So you have warehouses, storage, manufacturing. The big pro for this one is that there's stable tenancy with lower operational costs, usually less hands-on management too. A con is there's market vulnerability, of course, in this type, especially with like tariffs. And this property type is really location dependent. So you have to know which cities to go into and even which areas of the city for sure. A question would be, how do you calculate the base rent for industrial? An answer would be, well, it's the price per square foot multiplied by the square footage of the property. So if it's $40 per square foot and then there's 10,000 square feet, you can do the math. And the last property type is the largest. It's retail properties. And this is a huge category because it makes up businesses that sell goods and services to consumers. Examples would be like shopping centers and malls, big box stores, restaurants, even gas stations. The cost can vary significantly in this property type because there's just so many different categories within it kind of. Most people really never even touch this type. And that's totally fine. Like, you need big money, expert management, and it comes with a lot of inherent higher risks. But hey, if you've got some resources here to go buy a shopping mall, go for it. And now you have to think like, well, which property type is right for you then, given where you're at? It really depends on where you're at financially, how much hands-on management you want to do, and the risk that you're ready to take on. A general rule that I've seen work with our clients at rentalconsulting.com is if you've already got about, say, $100,000 or more in the bank, saved, ready to invest, then I'd say you can start looking at commercial. Otherwise, as a beginner with less than 100,000 and kind of newer to the game, maybe you don't have any real estate experience yet, I would definitely start with residential. You can scale bigger later on and take those more complex deals down and, do that when you're ready. But I would start with residential multifamily if you're a beginner. Now, the next big question is, where should you invest? So click on the next video where I'm going to explain which cities offer the best opportunities and why. And if you found that this video was helpful, hit the like button, subscribe, share it with someone that's looking to get into real estate. And thanks for watching. I'll see you on the next one.